Chapter 10 presents stockholders' equity. Recall that stockholders' equity is the owner's claim to assets. The fundamental accounting equation can be rewritten as follows. Assets are our resources, liabilities are the non-owner's claim to those resources, and stockholders' equity is what's left over for the owners. There are three primary sections. First, what is paid in, those amounts contributed by the owners in exchange for common stock or preferred stock that we will discuss later. Retained earnings are amounts that we have earned through our operations. And treasury stock is a new term that we will examine in a minute. It's actually a reduction in our equity for the repurchase of stock. Let's first review the characteristics of a corporate form of business. A corporation is a separate legal entity. Unlike a sole proprietorship or a partnership where two individuals go into business together, a corporation represents a separate and distinct business entity owned by the individuals. The advantage of this distinct and separate business entity is that it limits our liability to the amounts that the owner has contributed in exchange for stock. The shareholder could lose this cash, but it's limited to that. Personal resources are okay and not subject to loss. A third advantage is that the ownership rights are easily transferable. If you're a stockholder, you can easily sell that share to another individual or interested investor. And in fact, this can be done on a large-scale basis. The corporation, if it wants to raise large sums of money, can issue shares to the public. These advantages don't come without a cost, however. Because the corporation is a separate and distinct entity, it is subject to tax on profits that it earns. The shareholder ultimately is subject to tax again when it receives a dividend or when the shareholder sells the share in exchange for a profit. There are three principal rights that a shareholder enjoys. First is the right to vote and elect a board of directors who will oversee business operations. Second, when a dividend is declared, the shareholder is entitled to receive that. Thirdly, if and when a company liquidates, the shareholder has the right to receive the distribution of assets. To date, we've discussed only common stock. Common stock is usually the type of stock that a company issues if it has only one type outstanding. Common shareholders can be thought of as the true owners of the business. Let's discuss some terms associated with the number of shares issued. If we think about the corporation, it is formed when it goes to the state, say the state of Ohio, and receives authorization to begin business. Authorized shares is the maximum number that a company could issue, say 1,000. The number issued are those that have actually been sold. At some later point in time, a company might decide to repurchase shares. Those are said to be held in treasury. If a company repurchases 50, there would remain outstanding only 350. These are the shares that are active. The shares that are held in treasury do not receive dividends and do not have the privilege of voting. Take a minute to review these terms and understand this relationship. Continuing to introduce new terminology, we see the term par value. Par value is the legal capital per share of a company's stock that's assigned when it is first established. The term par value really has no significant meaning today. It has no relationship at all to the value of common stock. Additional paid in capital represents the portion of cash proceeds received in excess of par value. Par value might be set typically at an arbitrarily low number, even as low as a penny. But when issued to the public, it will be issued for fair market value, say $5 per share. In this case, additional paid in capital would be the difference, be $4.99. Let's examine how we would record this. If XYZ issued 100 shares at $20 per share, the company would be receiving $2,000 of cash proceeds. The 100 shares multiplied by the 20. We will credit common stock for only the par value multiplied by the number of shares. 1 penny times 100 shares would be only $1. The difference is what we record as additional paid in capital. That would be the $1,999. We've discussed common stock. Now let's distinguish it from preferred stock. Preferred really means a preference relative to common shareholders. It does not necessarily mean that it is better. The preferences are a first right to receive dividends. If and when a dividend is declared, it is first paid to a preferred shareholder before the common shareholder is entitled to any. There also is preference in the event of corporate liquidation. Recall the fundamental accounting equation. We're now distinguishing in the equity section between common and preferred shareholders. Our resources first would have to go to satisfy non-owners' claims. Second in line would be a preferred shareholder, and then last would be the common shareholder. While a preferred shareholder enjoys these preferences, the preferred shareholder typically does not have voting rights. Treasury stock represents a corporation's own stock that it has reacquired. Treasury stock is a contra-equity account that reduces total stockholders' equity on the balance sheet. Let's examine the transactions related to treasury stock. If ABC issues 100 shares at a price of $12 per share, the company would receive $1,200 of cash. We're going to credit common stock at its par value, and we're going to credit additional paid-in capital for the excess. Later, when the company reacquires shares, we're going to record our contra-equity treasury stock, and we're going to credit cash for the amount paid. 20 shares at a cost of $15 per share will be $300 of treasury stock and a $300 cash outlay. At this point in time, our equity on the balance sheet is $1,200 of credits less $300 of debits. $900 is our net equity on the balance sheet. Let's continue that example and assume that ABC reissues the treasury shares at a price of $16 per share. The company will be receiving $320 in cash. We will credit treasury stock for only the $300, which is 20 multiplied by the $15 that have been paid for it, and we will credit additional paid-in capital for the difference. If instead of reissuing it at $16 per share, we reissued it for only $14 per share, the entry would change as follows. The cash that's being received is only $280. We need to credit the treasury stock for the $300 that had been paid, the 20 shares at $15 per share, and in this case, our difference is a debit to additional paid-in capital for $20. You might be asking yourself, why would a corporation repurchase its own stock? Well, one is to send a signal to the market that it's undervalued. This will boost the price of the stock as it trades on exchanges. It also boosts earnings per share. It reduces the number of shares outstanding. And lastly, it provides the company shares that it can reissue when issuing stock options and other awards to employees as part of stock compensation plans. Common stock and preferred stock represent contributed capital. Let's now focus on earned capital. Retained earnings, recall, represent the earnings kept in the corporation, the earnings not paid out as dividends to stockholders. It is a cumulative amount. It equals net income less dividends since the corporation began. If in year one we had net income of 10, paid no dividend, our retained earnings at that point would be 10. If year two we earned net income of 5, paid a dividend of 2, we would have an increase of 3, our retained earnings would become 13. Year 3, if we had net income of 7 and paid a dividend of 1, we would have a $6 increase in our retained earnings, and our retained earnings at the end of year 3 would be 19. The cumulative nature also applies to losses. If in year 1 we incurred a loss of 5 and a profit of 3, our retained earnings at the end of year 2 would be a deficit of 2. At the end of year 1, it would have been a deficit of 5. We said retained earnings is net income cumulatively which has been kept in the company. Dividends represent distributions where earnings are paid back to the stockholders. These dividends are not paid on treasury shares. Treasury shares are held by the company and they are not active. There are 3 important dates to understand that relate to dividends, but there will only be 2 journal entries that we record. First date is the declaration date. On that date, the company is declaring a dividend, which is a reduction in retained earnings, and we will credit dividends payable. The dividend will be paid at some future date in time. This could be, for example, let's say June 5th. People are buying and selling the shares, so we need some date at time when we will determine who owns the stock and who will be entitled to this dividend. The date of record might be, for example, June 30th. On this date, we will make a notation in our company records who owns the shares so that we know who is going to get the dividend, but there's no journal entry. There's no journal entry because the fundamental accounting equation is not changing. We're simply determining who is going to get the obligation that we established on the declaration date. Finally, the payment date might be, for example, July 10th. On this date, we will reduce the dividend payable and we will credit cash for the dividend actually paid. So we've discussed common stock, preferred stock, and our earned capital, retained earnings. These amounts will be reported on the balance sheet in our stockholders' equity section. Notice we have both common and preferred. The terms we discussed earlier. Our authorized shares is the maximum number that can be issued. The shares issued are the ones that have actually been sold, and those outstanding are the ones still active. The difference between issued and outstanding, recall, would be treasury stock. In this case, the company has no treasury stock, so there is no contra equity. If there were treasury shares held by the company, it would reduce the value of our total stockholders' equity. Additional paid-in capital, recall, is the amount in excess par value. For both preferred and common stock, the number of shares issued are recorded at par. Notice we have 1,000 shares issued, $30 par value translates to the $30,000. Here we have 1 penny per share multiplied by 2,000 shares issued gives us $20 of par value. The excess is recorded here. ROE measures how well company management is generating earnings from the resources that we as owners have provided. The higher the better. Earnings per share measures individual shareholders' claim to net income. Imagine Company A, which has net income of 100, with only 20 average shares outstanding. That's an earnings per share of $5 for each share of stock. Company B might similarly have $100 of net income, but it might have 200 shares stock outstanding on average, representing a claim of only 50 cents per share. While the two companies had the same amount of net income, clearly from a stockholder's perspective, the Company A scenario is preferred. Said differently, we have the same size pie, 100 net income, but in this case we're slicing it into fewer pieces. We get a bigger piece of the pie if there are only 20 shares outstanding as opposed to 200.